FOREX.com. We're getting on to US CPI. This could be a really big data point. It could be a really big print. As a rule, I try not to make any individual data print out to be bigger than it needs to be. So like, I don't try to like catastrophize these ordeals in any way whatsoever. But with that said, there's a lot that's hanging on this data print, on this data point. And I think there's a domino effect that could hit if this comes out in a certain way. So I'm first waiting for the feed to come through on YouTube. As soon as I have confirmation that everything is loud and clear and good to go, we're gonna get this session started. As usual, any questions you have or setups you might want to take a look at, feel free to fire those my way. I will do my best to answer whatever I can when we get to the video portion or when we get to the Q&A portion of today's webinar. Just taking a quick look, making sure that it's coming through on the YouTube side. And then we need 30 seconds on the disclaimer, and then we'll get started. All right, there we go. Looks like we're live on YouTube. And so again, thank you very much to everybody for your time in advance. I'm going to look at the USD. The big driver here, I think, is still dollar yen. I think that's a highly pertinent market for all of the FX world. I think it also has an impact on gold. I think stocks are kind of doing their own thing right now, but I'm going to look at those as well. I'm still pretty bullish on equities and have little reason to bounce off that view. But all right, that's 30 seconds on my watch. Let's go ahead and get started. All right, first and foremost, I want to take a quick look at what we're looking at for tomorrow. So for headline CPI, the expectation is for a 3.4% print. Core CPI at 2.5%. That 2.5%, it's not all that alarming. It's not as worrisome as it could be. But I wanted to use this to show you why we're at where we're at. So let me first dial this back. I'm going to look at data on CPI going back to like early 2021. And so what I have here, this is the month and year that it was released. And you'll see if we go back to 2021, this is when the Fed was saying, oh, it's supply chain related, it's transitory, we don't need to hike rates. Ends up just becoming a problem. You see what happens in 2022. Headline CPI goes up to like a 9 handle eventually. But by that point, they had kind of realized that they needed to hike rates, that they didn't have a choice. And so it kind of put the market in a stranglehold. You had stocks selling off really pretty aggressively on the back of these 75 bip hikes that the Fed ultimately had to do. But you'll notice right here, inflation starts to soften a bit when we get to like mid 2022, and then it starts to come down a little bit more earnestly. What we've had now is just a glimpse as to what we had then. So I think a lot of the Fed officials that you see coming out saying that if inflation remains strong, we have to hike rates, I think they're just cautious of a repeat of one of those incidents. There's also a lot of the possible political overlay. Right? President Trump tried to get Lisa Cook fired last year, and maybe it's just coincidence, but she seems to be erring on the side of hawkishness at this point. But that's headline CPI. This includes energy and includes food. We had this flare earlier this year. Notice that data point got up to 3.8% in the May release, 4.2% in the June release. That was June 10th. I'm going to tie that in here in a moment. And then it softened last month at 3.5. Expectation for tomorrow is at 3.4. Core, however, has been a lot more stable. Now, core strips out food and energy, but when we're talking about inflation from higher oil prices, core CPI isn't necessarily immune, right? Because in the United States, pretty much every product that we get is shipped via transport. It's shipped via truck. And so when oil prices go up, the cost of getting a widget from point A to point B also increases because of those transportation costs. And so often you'll see a flow-through effect of higher oil prices, higher energy prices, hitting core CPI. In this case, I'm just looking at core CPI since January 21, or excuse me, from January of last year. You'll see it's been relatively stable. And then to make that same argument, let's go ahead and draw this back all the way to the beginning of 2021. We haven't quite seen the same flare in core CPI that we did back then. And so like arguably from a core CPI perspective, of the inflation, the non-energy, non-directly related energy inflation hasn't really shown here yet. Now, the reason this matters is because if we look at where rate expectations are right now, there's still a pretty hawkish expectation. Let me update this, make sure it's the most recent data. It's a veritable coin flip for a rate hike in September. I think this is highly contingent on that print tomorrow, but you go out to the end of the year and it's roughly 80% that we're going to get at least one hike. And, if we look at it from a core CPI perspective, it's not necessarily all that worrisome. It certainly isn't to the same degree that the Fed was dismissing back in 2021, right? In 2022, when they ultimately did have to hike, we had this quick little pop, and then it started to recede. Now, for tomorrow, again, expectations for the soften out to 2.5, that's softened down to 3.4. I think if we get a big delta to that print, if we see like a 3.3 or lower on headline or a 2.4 or lower on core, I think we're going to see some of these rate hike bets evacuate pretty quickly. And I think that could have a strong repercussion across numerous markets, FX included. Now, on the data front, after CPI tomorrow, we're not done yet. We get PPI on Thursday, and then on Friday, we get a couple of important pieces. So this isn't necessarily something where the week is one and done after the CPI print tomorrow morning, but I think it's going to have a big drive across a multitude of assets. USD, of course, is front and center, but I think there's still something else doing the driving here, and I think that is right over here in dollar yen. If you look at dollar yen, and you go back all the way, and I'll get to these in a moment, but you go back all the way to like 2021, we're still more than 50% higher from those early 2021 values. What creates a price movement of that magnitude? It's more buying and selling, more longs than shorts. You got longs that are loading the boat, and not an equal number of shorts, hence the upward trend. Now, there's a reason for this. The backing fundamentals were decisively long. Like in 2021, when we saw that inflation starting to climb, market participants, they're not stupid. They see that higher inflation in the US, and even though the Fed's saying, we don't got to hike rates, it's supply chain related, it's transitory. Markets are factoring in the possibility that the Fed ultimately will need to hike, and that's what helps to explain this rally that we see in 2021. 2022, when they actually begin to hike, now there's some actual drive on that fundamental relationship. You have higher rates in the US, lower relative rates in Japan. This thing goes parabolic, and it just continued to. And we climb from like a 110-ish area, let's call it like 115, up to 150. Now, the problem is along the way that yen weakness is so profound that it comes with the possibility of exorbitant inflation in Japan, the possibility. And so that's one of the reasons that the Ministry of Finance kind of wants to slow down matters. So like right here, they start to kind of hint that they're going to intervene at 145, and they do, and they fail. I mean, it got a day of weakness, and then buyers jump in and they just pile back on. Notice the way this hits though, right? The market dynamics within this move are just fascinating. Because you got that 145 line in the sand, and it's like we tease it. But after that pullback, there's probably a bunch of stops that are lodged above there from traders thinking, well, they defended 145. They'll do it again. And if they don't, I want to get out relatively quick. Well, you could see those stops becoming rocket fuel as this thing pushes up to the next big figure at 150. Now, the BOJ ultimately intervenes again. We get one daily close above 150. This was a bloody Friday for the yen. It went up to 150, 195. The BOJ intervenes, and that puts bulls on their back foot for a little bit. Now, notice buyers are still responding to these supports. So like we get a pullback to this prior resistance rally, a pullback to that prior resistance rally. But notice what happens. We get closer to that 150 level that the Bank of Japan had already intervened. There's a less and less attractive risk reward ratio for chasing that trend. And then longs that have been holding on have that bounce. They say, you know what, I'll just cut it and I'll get long later. Now, what ultimately compelled that reversal? The US CPI print. Now, that US CPI print was not weak. It was 7.1% for headline, 6.3% for core. Fed's target's 2%. These are both massively elevated. But They were below the prior month print. They were below the expected. It was a change in trend, or signified a change in trend, and it gave hope that maybe the Fed had a handle on this inflation problem. And now you get the mass exodus. But it wasn't BOJ intervention that caused the reversal. It was CPI, and that's what makes tomorrow so interesting. We've seen the BOJ intervene. It's put bulls on their back foot. If we get this CPI print tomorrow coming out significantly weak, like I said, the expectation for tomorrow is for a 3.4. It's for a 3.4 and a 2.5. If this comes out significantly lower and it dashes these rate hike hopes, well then maybe there's reason for another one of these to develop for traders that are long to take their cash off the table and wait. Because we already know that not only the BOJ, but the US Treasury Department wants to draw that line in the sand. Now, in this episode, that caused a couple months of weakness. This was November 10th, 2022. It bottoms January 16th, 2023. It was a 50% retracement of that prior move, most of which happened in like 2 months, more than 2,000 pips. But ultimately, the fundamentals remain biased to the long side. Buyers load back up. They get back on the bid, and they drive this right back up to those prior resistance values. 2023, we're back up to 151.95. Same story. The BOJ had intervened there. Traders were cautious of crossing that line in the sand, fearful that they would intervene again. That was a below expected US CPI print on Tuesday, November 14th. Price breaks down, reverses. Again, CPI was way too high at that point, but it was a change in trend, a change in tone that compelled some of those long-term bulls to close positions. This time it was only a 23.6% retracement. Again to 2024, inflation is stubbornly high. That was a US CPI print, the morning April 10th. Didn't look as though the Fed was going to be able to cut rates. So see what happens, those 151.95, the stops that we're setting above that, rocket fuel as this thing breaks out to the upside, runs up to 160, intervene again at 160. That one failed. But this is another thing to remember for tomorrow. As we came into the morning of July 11th, dollar yen was back above 160, the level the BOJ had intervened at. It looked like the BOJ had failed. I think the logical look was for price to move up to a 165 or so. The morning of a US CPI print, the BOJ intervened right around the release, and this one was below expected. It caused a mass exodus because now not only do we have this reason coming in, but we had that reason coming in too. It was like a perfect storm that ran through stops on dollar yen longs. And it just picked up speed along the way because now you have all these long-term carry traders that are still holding long positions. They're saying, you know what, Fed's about to start cutting rates. I don't need to hang around to see how far this might go. Notice how oversold this move got. I mean, we had an RSI like sub 15, 13.71 at that point. That was the morning of August 5th. August 5th was a big day. This is when the NASDAQ bottomed. Now, here's the wrinkle. I know many traders that have been around equities have this bad is good, good is bad type of theme where bad news means more Fed accommodation. So higher stock prices. This was a CPI miss. CPI came out below expected that morning. So it should be something that helps stocks, especially the overbought tech stocks. It didn't. NASDAQ 100 put in a bearish engulf on that morning, and it just continued to spiral. And right here, you had the third highest ever spike in the VIX index. The NASDAQ was coming undone. And there was a lot of accusations that it all started with a BOJ intervention. Because what's happening? But deleveraging. So as we go into tomorrow, the BOJ, they're not stupid. They've seen this persistent strength that dollar yen has put in since the intervention effort. And this time, it's not just the BOJ going alone, as they were here. We're here. We're here. Now they have the help of the US Treasury. Both economies want to see the spot rate lower. Paradoxically, the pair bottomed like 2 days before the Fed started cutting rates in 2024. And then throughout, you have an 1,800 pip run in this thing as the Fed's cutting rates by 100 basis points. This goes to show you, it's not the actual news that often pumps these things. It's the expectation of what that news will be and then the delta thereof. Now, The intervention. And what made this so forceful, and I went over this at the time, is it wasn't just the BOJ. As a matter of fact, the BOJ's efforts look to be pretty meager, all told. By my estimation, it was after the Fed rate decision, we got a pullback, and there was a hold of support and an attempt at a bounce. This started to tilt lower around the European Open the morning after the Fed and after the BOJ. And that is what I think was the actual BOJ intervention. This was at U.S. market open. This was the U.S. rate check. It's when the U.S. Treasury started calling around to banks asking for quotes on dollar yen. They started to freak everybody out because now it's not just the BOJ intervening, it's also the Fed. Quick spike lower. That bounce also faded pretty hard. That weekend, the next week, that Friday even, there were circulating reports that the Treasury had asked the New York Fed to call around to member banks to warn them that they might intervene. Spiraling situation. I covered this in the video that for that weekend, and as I said, a 155 was somewhat attractive because it's not like they were going to intervene again down here. And it took a little while, but you'll notice the bulls slowly started to get more comfortable with this, and they've continued to scale this on a 4-hour. But we know where the line in the sand is that was defended before. The BOJ, they don't like to look like failures, but Scott Bessent really doesn't want to look like a failure. He really doesn't want to look weak here. He's also got his hands tied to a degree because an intervention from the Treasury Department is not a normal thing, and the way that he went in with it, or I guess the reports about the way that he went in with it, highly unorthodox, shall we say. But as we get closer to that 160 handle, for almost like fairly confident 164, 165, but as we get closer to that 160 handle, we have a similar dynamic of what was happening back here in like October, early November of 2010, where it's like as we get close to that theoretical line in the sand, that theoretically capped upside, the risk reward is just simply unattractive on chasing this higher. And then eventually, if we do get something that blows a certain way, going in the opposite direction, there could be rationale for shaking that branch, that very crowded trade with a very crowded exit. And that's what I think is the highlight of what tomorrow could be. Again, I try not to overly catastrophize these deals, and I go in with the central expectation that it's going to be around the expectation and that volatility is going to be lackluster, but you got to hold out for the possibility of something of an outlier event as well. And that's what I'm looking at here with as we go into CPI tomorrow. If we do get a beat, if we do get stronger probabilities of a rate hike, if we do get dollar strength, it could bring that 160 level into play. Maybe this is where bulls get bold enough to actually test the resolve of the BOJ and the Treasury Department. And that's where we get to see if they're going to react. And if they don't, if we tiptoe a little bit higher, it kind of becomes a waiting game of when or where that might ultimately play out again. But I think a lot of the flows in USD are going to come from this. The other pairs I'm going to look at, I'm going to try to divorce this situation because the reality is I don't want everything aligned to just on a binary bet of what's dollar yen going to do. But I'm still of the mind that as goes dollar yen, so goes the dollar basket. Short term, still bullish. We get a pullback to like a 158.57 prior resistance. It's a 38.2 Fibo of the pullback move. That's something that could be somewhat attractive, especially if you see some support build, the way that it did around the 23.6 around the NFP print. But that reaction to the NFP print, I think, is what shows this possible vulnerability, which is a nasty NFP print. It temporarily hit rate hike odds in the US, and you jolted a few of these long-term longs out. Bulls just loaded the boat back up, but again, the perceived risk reward as we grind higher becomes less and less attractive. A lot of intrigue on this one, though. I think it's just fascinating, which is why I've spent 20 minutes talking about it. But let's move on to some like actual setups that aren't just based on the decision processes of a couple of different people. USD. So short term, this is grinding into a big area of support. Weekly, you can see where it's holding on to this trend line. So we had the recent breakout, we've had the pullback, and so far it's a show of higher low support or prior resistance. You look at it on the daily, it becomes a little less encouraging because each of these bounces has brought in more of a selling effort from bears that are kind of timing out on this thing. for this to break out, get back above 100, 120, 100 spot 22, 100 spot 40, I think not only are we going to need to see some pretty strong U.S. data, we're going to need to see these rate hike odds firm up, pretty well for September. It's a variable coin flip, and that's, it's just a hard thing for me to buy at this point, because you think of how much trouble Trump went to name Jerome Powell's successor. If Kevin Warsh comes out and presides over a rate hike in just his third central bank meeting after he was nominated, it's going to make Trump look pretty bad ahead of midterms. And I would expect Trump to just excoriate Warsh and the Fed if that happens. But I think he's been hedging that a bit of recent, and saying that it's not all Warsh's decision. He even said that he wasn't going to criticize him. And Trump's, I think, kind of taking that political angle of the Fed, which, well, it's like all other issues today, could be very divisive. But you see Fed members like Lisa Cook or Neel Kashkari, and it kind of falls out of tune that they're suddenly hawkish. And, well, I'll leave that up to you to decide. But longer term could still justify this for strength. Shorter term, that's a big area to look for lower high resistance to play, right around 122 to 100 spot 40. This is a big zone. This is what came into play when the Fed started cutting rates back in 2024. Same thing. They start cutting rates, dollar flies higher. It's not the headlines, it's not the fundamentals that are always going to push it. It's the market expectation to that, and then the delta thereof. But that's a big spot. Notice it came in as resistance multiple times. We looked at that in these webinars throughout last year. That's now the big spot. And if bulls could get back above that, that's when this weekly is going to start looking pretty attractive, as we had a pullback, a dip, and then price ran higher. But I don't think we get that unless we have like a white flag being waved in dollar yen. And I think we need to legitimately see dollar yen over 165 to think that Basent backed off this whole idea, this whole concept of the Treasury defending the rate. He had a comment saying that he wanted a Bretton Woods 2.0 kind of deal, which, that's something that is an expansive kind of comment that could be elaborated on. But I don't think that he has any reservations in trying to push a currency value in the direction that he wants to see it. But that's what I'm looking at in the dollar. Euro dollar. This one, again, as goes dollar yen, so goes the dollar basket. But this one, it at least has what have been some clean technicals. This is the same chart I looked at last week. As we went into the Fed 2 weeks ago, we had a pretty clean textbook falling wedge formation that had built in. That broke out at the Fed, got another shot in the arm with the yen intervention. Again, nothing spectacular was happening here overnight Thursday or Thursday morning around the U.S. Open. This was dollar weakness emanating from carry unwind in dollar yen. It was just flowing through the euro as well. It's been, kind of chunky, but it has been higher highs and higher lows throughout. It's that same zone I was looking at last week for resistance, 1576 to 1613, that so far has held the highs. So I have this in a bullish place from the daily, from the 4 hour. This is the zone of S1 support from like 115 up to 115.15. This is my S2 from like 114.55 to 114.69. And S3, I'm going to leave it as a pick'em because I have a couple of different levels that I like. This was a spot of resistance turn support at 14.36. 114.02 is a pretty big Fibonacci level. It's a little messier. Let's not include that one, but one of those two as the S3 for now. $4 weakness, I still like cable a bit better. Very similar falling wedge that had brewed going into the FOMC rate decision a couple of weeks ago, broke out with gusto at the Fed rate decision. I think the big takeaway from that Fed rate decision was, and I don't think this was just me, is I think the market has completely misread Kevin Warsh. And I think there's a reason why. I think if you're Kevin Warsh and you're coming in and you have all these comments from Trump saying, a willingness to cut rates is a litmus test for whomever I'm going to choose. Too late Jerome Powell. He just absolutely excoriated Powell in Powell's final year. You look at that whole context, that whole backdrop, it puts you in kind of a loaded situation, because if you come into the Fed and markets just expect you to cut rates, regardless of the backing economic situation, well, that's what produces this. That's where you see long-term rates shoot higher under the expectation that there's, very little care or control about inflation. That's why tens, are nearing this very vulnerable point. 4.7, 4.8%, go out to like a weekly. We haven't been at those yields in a very long time. And when we have, it's been, few and far between. 30s, even worse. 30s had a fresh 19-year high. And this really puts Kevin Warsh kind of behind the 8 ball. So he has to sound hawkish to retain any kind of flexibility with markets. I think that makes sense. But when I heard that rate decision, I mean, it really sounded as he was overly polished, but it really sounded like somebody that they're not going to hike unless they absolutely have to. Unless we see this inflation data point, a hockey stick like it did back here, it sounds to me like somebody that really has no interest in hiking. And then when we got this dip last month in headline inflation, and this comes along with a heavy tie into oil, but when we had this dip in headline inflation last month, that's kind of the ammunition that Warsh needs to justify no hikes for now. Now, again, it's a vote across the Fed board. It's not one person's decision. It's not a dictatorship. But the Fed chair is the one that kind of steers the conversation. And as a case in point, you've had all these Fed members coming out sounding hawkish. They didn't vote for a rate hike. They could have voted for a hike in June when inflation flirted up to 4.2%. They could have voted for a rate hike last month. They didn't. You had 3 dissenting votes, and many of those that are speaking out now, they didn't vote for a hike. They could have, but they didn't. But that was, I think, the work of the Fed chair. So, even to this point, it's 50-50 for September. It's 80% going into the end of the year. There's a lot of room for that to come down, and I think that's something that could justify USD weakness. And I think that has to emanate from that dollar-yen carry unwinding or breaking down. But for USD weakness, this is a pair that I really like. Now, at this point, and I covered this in the opening bell yesterday, and I put that video on YouTube, so hopefully some of you guys saw that. But we had a pretty clean ascending triangle that had built with 135 coming in as resistance. 135 in cable. It's kind of a dramatic level long term, but it was holding resistance at the time. We got this quick breakout, and you see right now this morning, bulls are trying to hold price back up. We're back above the spot price right now, but take a step back, and this is why I think that deck is so loaded, because we're at this resistance trend line that has turned away a few different advances. If we do finally get above that, there could be some fresh powder just overhead. So it's got work to do before it clears 135. Of late, 135 has been a pretty hard fought area. It's not like there's a dearth of history above that price, but it's like once we get above 135, some buying interest has waned, and that's why we've had some pullbacks. But if we're getting a legit situation of dollar weakness, I think this is something that could possibly fly pretty beautifully in that scenario. But again, the domino effect that we would need is, I think, softer inflation pushing down these rate hike odds, which compels a deeper pullback in dollar yen. Again, very similar to what we had seen July of 2011 or November of 22. November of 23 even, November of 22, November of 23, July 2011. All of those were brought upon by weaker than expected US CPI prints. I mean, I could show you the day that they started, and it was the morning of a US CPI print. I think we need that US CPI print to break down pretty heavily tomorrow to evacuate these rate hike odds. And then I think that's something that lifts, I think that lifts euro, cable, drops dollar yen, breaks down USD, nullifies that USD rally. And if you're Trump, if you're Besant, that's exactly what you want to be seeing right now. And I think it's also something that could help equities. This is another one that I have on the side of short side USD. It's Aussie. RBA had a rate decision last night. It was a hawkish hold. You look at price, we're pretty much around where we were yesterday, so much ado about nothing at this point. But if you look at this pair, this really has the appearance of something that is more concerned with U.S. inflation than anything else. As a case in point, it was June 17th that we had that rate decision out of the Fed right here. Notice that is what ultimately sprung this test below the 70 handle. It was June 10th was the last CPI print, or the CPI print before that Fed rate decision right here. You can see that was the first retest below 70, and then it sunk below 70 after the Fed. And ultimately, kind of like I'm referring to with dollar yen with cable above 135, Aussie at 70. Once we get below 70, things have things kind of shift, things kind of change. It took a while to get above 70. Now the same thing below 70. But where this one comes in is more exciting in my mind is if we get an inline print tomorrow, a quick jolt of USD strength, they could pull this back. And then there's this very open area for support to show from 70 up to like 70.21 thereabouts. Notice it's pretty messy. There's a lot of wicks, but when you see those wicks, that's reaction. And those reactions happen for a reason. And if we get down there for a retest, maybe it happens again. But if we do get in line or maybe even slightly above on one of the 2 points on core or headline, maybe there's a quick jolt of USD strength. Maybe this is something that, like, and just to play through these scenarios, maybe this is something that gives dollar yen that jolt to run up to a 160 test, right? A quick rush of excitement on higher than expected CPI. And we get that, then Aussie, the play is to look for a test of that support and then some element of reaction. And so not only do I want to see price in that zone, I want to see bulls reacting to price in that zone. I want to see some underside wick on a closed daily bar. 4 hour, you could see on these swings, it gets kind of messy, but similar. I could look for an underside wick, if it's like a hammer type of formation, even better, even cleaner. But nice little trend that it's built so far since the July open, since the Q3 open. And so maybe something that can continue. You look at this on the weekly, you see that resistance right there. That's a big test. At this point, a bear could probably even justify that as some lower high resistance. The reason I'm more cautious as such is because we had this prior swing and then that swing, and I'm construing that as a higher low after a recent higher high. So I'm looking at this as bullish from that daily perspective. One that I think maybe has a better case for USD strength over here in dollar CAD. So dollar CAD, big figures play a big role in this pair. And that's often the way that it goes with a lot of these natural crosses because there's a lot of cross-border trade. And, when you have, say like Canadian businesses that do business in the US or American businesses that do business in Canada, that exchange rate is profit potential, right? You get dollar yen or dollar CAD flaring up to like a 145. That dollar is really expensive. CAD's really weak. So, that's going to impact how you're making business decisions. You get dollar CAD at 120, CAD's really strong. USD is really weak. If you say like you're a car dealer, for instance, and you have a weak USD and a strong Canadian dollar, a good time to be buying cars in the US and then selling them for cash in Canada. You basically try to play that arbitrage off of the exchange rate. Or if you have a weak Canadian dollar, a strong USD, good time to be buying cars in Canada, selling them in the US. So as a point of that, there will often be a tendency for these psychological levels. Might even still have this, but there's a tendency for these psychological levels to produce support and resistance over a long-term basis. It's not always going to be perfect. It's not always going to be clean because we get up to like 124.80, and those businesses are like, hey, that's a pretty expensive spot. It's almost $1.25, and then we go down, and then we test the next psychological level lower, 130, 140, 135, and those relationships have carryover. As case in point of recent, it's been the 140 handle that was holding the low in dollar CAD until last Friday when the bow finally broke. But when you look at the way it broke, right? Initially, bulls come in, they defend it, they give a bounce. We get barely below, they defend it, we get a bounce. Barely below, that bounce is even weaker, and then we break down. You can almost see where it's sliding and slipping in real time. Now we're below that 140 handle. 139 is a level that I've been watching. Right in here. We haven't quite tested that level yet. Earlier in the morning we had higher lows. That relationship is not there now because we just broke down. We just tested just below that. But where this becomes, I think, a bit more exciting for USD strength is if we get that test below, if we get that capitulation factor. And what I mean by that is I want to see a test below, and then I want to see bulls return to pull it back up. That's a good example right there. See that long extended underside wick? Sellers had their open door. Not only did they fail, buyers come in, retook control, run this right back up to fresh near-term highs. But it's right in there. It's that capitulation that you saw in the 139 break that got us the 140 test. That could be a pretty attractive candle to look at on like a 4-hour basis to indicate some element of failure at support. Failure from sellers to drive on a support test. Now, here's the beauty of something like this. Like, I've been doing this long enough to know that I'm never going to predict anything. And I don't try to predict anything. I don't try to use my analysis to predict anything. I try to put pieces together. I try to draw similarities like I'm looking at now with the BOJ, Bank of Japan intervention scenario, a CPI report, all that. I try to draw these parallels, but the reality is a small sample size is a small sample size. You just got to call it what it is. At the end of the day, I think the only thing that matters is risk outlay, because it's the only thing I'll ever control. The beauty of something like this, when you do get it, is you have the support test. So your thesis essentially is the support was defended, but you know where you're wrong. And stop goes below the underside of that wick. I don't want to put it right at the underside of that wick. I'll put it a little bit further. I'll try to nest it so that if we do get this shaved and then it bounces, I don't just automatically get wicked out, but you know where you're wrong. And then from that, you factor where it needs to go to signify for you to be right. And by right, it means a factor of that risk outlay to make it a worthwhile trade setup. But that's the beauty of those capitulation candles. And they'll pop up pretty often. That's one of the reasons I'll go down to the 4-hour, even though the 4-hour is a little bit messier, a little bit less deterministic. But dollar CAD, it's sell-off, it's bearish right now. It's not rallied, but below that 140, something might be opening up on there before too long. All right, gold. So saved my favorite one for last. It's not last. I'm going to look at a couple things after this, but gold. So been on gold for a long time now, and to those of you that regularly attend this webinar, I apologize because I go over the story way too often. But I think gold has an incredible way of trying to look around the next corner. And if you look at gold and the way it worked with 2K, the story of how it worked with inflation, how it worked with rate expectations, how it worked around this recent Fed cycle, it's just fascinating to me. This is probably why I tell the story so often. So you get the COVID pandemic, gold initially gets shocked, but the Fed comes in with the whole artillery of stimulus and gold goes vertical, finally gets 2K. 2K was kind of like a storied level in gold, because if you go back to like 2011, it got really close, like 1920-ish is where it topped out. But it's almost like just approaching that 2K handle after this parabolic run, this one-sided move just started to go back. Well, it finally got 2K, summer of 2020, when the Fed is just full bore on the line. But it can't break 2K. Why? Well, my thesis on this is that this is where Bitcoin started to take over. All right, think about July of 2020. The world is scared, frightened. This is when you started to see like NFTs, right? That NFT craze is just the most outlandish thing I've ever seen. At least with tulips, you had a flower. NFTs, a digital JPEG. But it's FOMO, it's mania, it's sociology at work in front of you. But you kind of had the anti-fiat flows all going into a different direction. I think that's why gold held 2K for so long. But as we get into, it was like November 2022, by the way, when the SBF thing came up, and this is right around when Bitcoin bottomed. But at that point, it was kind of like, okay, the world had recovered a bit, sanity had returned. And as the Fed starts talking up the prospect of possible rate cuts, you see gold come back to life. It tried to get above 2K, still couldn't do it. But what ultimately sent this above, December FOMC, Fed's projections show that they're expecting to begin rate cuts in 2024. The way that it reacted to that 2K level. Right there mid-December, we get above it. In early 2024, we don't even test below 2K. Until right there, Tuesday, February 13th. You guys want to guess what happened there? I'll show you. Tuesday, February 13th, 2024. It's this data point right here. Headline CPI printed at 3.1%, core CPI at 3.9%. It had come down quite a bit, but we are still almost 100% away from the Fed's 2% target on core. We are still well elevated. And notice it's in green, meaning this came out above expectation. The prior month was above expectation too, as were the next 2 months after on both counts. Inflation was stubbornly high. That print came out. I got to go down. Yeah, we're at daily. That print came out right here that day, that specific day, February 13th, 2024. Above expected US CPI print. Markets freak out a little bit. Dollar rallies, stocks sell off, gold sells off. There's an election later in the year, which I think might have some pertinence, but markets kind of freak out a little bit. A day later, this is Fed speak in action. This is one of the reasons that the change that Warsh's talking about with regarding forward guidance are so big. Austin Goolsbee, Chicago Fed president, he was on Obama's economic team, a highly followed economics person, Chicago Fed president. Also somebody with certainly defined political leanings. In a television interview says, let's not get all flipped out about one inflation report. I just showed you it wasn't just one inflation report. Multiple inflation reports before that. Inflation just wasn't working out. The Fed said they wanted to cut rates, and well, inflation's still way too high. Let's not get all flipped out about one inflation report. A day later, gold goes above 2K, and it flies. And it doesn't stop. It slows down a bit, but it doesn't stop. Now, you remember July 11th, 2024, that's when we had that below expected US CPI print that finally cemented market hopes that the Fed was going to be able to cut rates. That's what led to the dollar yen unwind setup. July 11th, 2024. You want to see what gold did? Broke out in a very big way, set another fresh high. We just saw buyers back away from 2,500, but that's when markets finally started to get the idea. They started to get warm with the fact that, okay, the Fed is legit going to be able to cut rates. They ultimately cut rates September, right in here, Wednesday, September 18th. That's already well factored in, by the way. We touched 2,600 at the rate hike and rate cut announcement, and we pulled back aggressively, and then we just go right back up. Gold has an incredible way of trying to look around the next corner. And if there is dilutionary policy in line, then this is something that could compel the long side of gold. I started seeing this line up 2 weeks ago. I tweeted this right after. Oh, let me find that tweet. I tweeted this right after. There we go. The Fed and BOJ. This was the exact date, July 30th. And gold had just started to peak out of this falling wedge formation. But the Fed posturing around rate hikes that they don't seem to really want to do. And Japan intervening. At this point, I didn't know that the U.S. Treasury Department had jumped in on the matter as well. But it's the same story. It's the same thing. These central banks, they'll say that their mandate is inflation, but the reality is they want to see higher stock prices. They want to prod growth if they can. And that's one of the reasons that gold has been on such a run. Because you look at inflation, you know what hasn't happened? There hasn't been a single print below 2%. The Fed has never attained their target since it went above it in 2021 on core or headline. And here we are posturing about whether they're going to hike or cut next. So it's become blatantly obvious to me that the Fed's dual mandate is a secondary consideration. Now, there's actually an economic concept behind this called the wealth effect. This was something that was popularized, or I guess initially popularized in the 50s. Something that was really grasped onto in the early aughts around the financial collapse, which is when Americans are opening their 401k safes, they see prices going up, they see their retirement accounts going up, they're automatically compelled to spend more because they feel richer, and the richer they feel, the more they spend. And that is what I think explains the rally in gold. It's this rethink in central banking, and if you look at it on a long-term enough basis, there's a couple of waves and phases in here, but you know the reality is there's a reason this has been up and to the right for as long as it has been. Now, more recently this year, we come into the year, we have all the kinds of inflationary shocks. We have Iran, which is an obvious inflationary shock due to oil flow through effect, and core CPI. There's all that fear, right? That's what takes over here. And that's why we were funneling lower. And then June 17th, again, big date. That was the Fed rate decision when the Fed starts to sound all hawkish. Notice what happens in gold. At that point, it's like bulls wouldn't even allow for a 4K test until after June 17th. Fed rate decision. We go right down and we test below 4K, but notice what doesn't happen. We don't stay below 4K. Each of those sub 4K prints brings new buyers into the mix. Now, the big widespread accusation is that there's central bank accumulation going on. Perhaps that's the case, but the beauty of price action is it is what it is. And someone was defending that 4K handle. And exactly like we looked at last week, it was that 40-23. I had a 40-21 last week, but it's that 40-20 area where higher low support played. And we broke out. And a week after I'd sent that, like I said, it was like July 30th, right in here. The breakout hits in a very big way. So as we go into CPI tomorrow, this is the big one, to my mind, at least. If we see higher than expected CPI, if we do see these rate hike odds firm up to where there's like a 60% chance of a hike, there's a valid case for dollar strength. I think that's something that exposes that dollar yen setup with that 160 handle. But I think that's also something that could prod a pullback to one of these levels. I got 43.58 as near-term support, but 43.05 is the level that I think is a little bit more viable for a deeper pullback type of play than this zone here, 41.66, 41.95. I get it. If we pull back there, it's going to start looking like it was a failure. But look at this with a long enough, with enough scope. Last week was the largest weekly gain since January. It really looks as though bulls are starting to retake control of this thing, and I think that's exciting. If this comes out below expected tomorrow, and we see these rate hike odds edge down a bit, then I think there's just more reason, more rationale on the long side of gold. But it looks as though that tide has turned. Now let's see the way that the data treats it. And if it does give a pullback, I'm looking at that, or trying to look at that as opportunistic for longer-term bullish continuation setups. What dashes this? I mean, what dashes this is I think we need to see inflation just blow out, which I'm not expecting. But if we see, and you know, again, I consider this like an outlier scenario, but if we see like headline at a 4 handle, then I think markets could freak out a bit. See these odds jump, and then there's you know, dollar strength, and it's going to run across many boards. But not my base case, but nonetheless something worth entertaining in case of. That's what I'm looking at in gold. Stocks. So, you know, the funny thing about stocks is they could be in a bubble and it doesn't matter. And this was something that we learned with NFTs and crypto, because like you saw a lot of really smart people operating in those fields. You know, why would you buy a digital JPEG? Makes 0 sense. There's one reason. You think you could sell it down the road to the next guy for more. That's it. What's the intrinsic value of a digital JPEG? Nothing. It's code. It's replicatable. You know, maybe you put some kind of meta tag in that code that makes it unique, but at the end of the day, there's nothing special about it. Nothing. But if you think you could sell it for more down the road to the next guy, there's motive in there. Now, here's the rub with the S&P. There's actual intrinsic value in here. There are companies that have earnings that owners of those companies get a claim towards. So it's not NFTs by any stretch of the imagination, but it also highlights that markets aren't always cleanly perfect realizations of those intrinsic values. You know, as a case in point, 2021, inflation's continuing to run higher. You saw this in dollar yen. Dollar yen's rallying even though the Fed's saying we're not going to hike rates. But notice what happens here. Stocks just kind of shrug it off. We get into 22, and this is when they had said, like, you know what, we might need to hike rates. Here's the funny part about that. It was like day 1 of 22, stocks start to pull back. We got the first rate hike in March. And notice it was a 25 bip hike, but we actually rallied thereafter. It was when inflation remained really high, and then it was like obvious that the Fed, they're going to have to do more work here. that this really started to spill. And I think this is Warsh's lament down here, which is actually somewhat of a successful point for the Fed. It was the communication item, right? You go back to June of 22. Remember, it was Nick Timmeros, Wall Street Journal, reports that it's right in here, June of 22. The Fed is considering a 50 basis point rate hike. I think he even said 75 at the time, but the Fed is considering a jumbo rate hike. See, stocks gap down, they run. Fed actually hiked, or excuse me, a jumbo rate hike. Sorry, I'm getting this all jumbled, but they're considering a jumbo rate hike of 75 bips right here. You see it gaps down, it runs. That's the rate hike right there. We had 1 day of pain after, and then it bottomed. Markets were so softened to that message because it was leaked 2 days before that it kind of contained the damage. Again, I consider that a success of the Fed's policy here, but the reality is the Fed has a blackout window. That's not supposed to happen. It's not supposed to be a leaked report to a Wall Street Journal reporter telling you what the Fed's going to do 2 days before they actually do it. You know, it's almost an arm twisting of what the Fed's supposed to be doing. You know, so with what Warsh is doing, it kind of seems like he's trying to bring the Fed back to their roots where, hey, we got a mandate. You know, we're not supposed to be the oracles of finance here. We're not supposed to be the stock market pumpers, you know, leaking reports of what we're going to do next to try to keep markets afloat. But with that, and I think this is what has markets a little bit on edge, with that is the fact that, you know, sure, there's some, you know, violent down moves along the way, but, you know, the reality is the Fed wants this to go higher. US debt load's going higher. There's more and more cash being pumped into these markets. There's a reason that it's been as bullish as it is. This is also one of the reasons that I try to bias this as bullish, because you get these little windows of weakness, and those are incredibly difficult to predict. The point where even if you do predict them, I mean, you could end up upside down really fast thereafter. I think the most opportunistic place to be is after one of those areas to look for a dip, some justification for support. Well, we're stretching up to fresh highs right now. It's tough to try to chase this, but where the window of opportunity possibly opens is when we look at this data point for tomorrow, when we look at these rate hike odds, if we see this flare out and come in higher than expected, you know, again, I expect that would lead to dollar strength, maybe even a dollar yen test of 160, pullback in gold, could also lead to a pullback in stocks. And there's a really warm area of prior resistance here that hasn't yet been tested for support from around like 75.82 up to around 76.20. It was a gap and go, and we haven't pulled back yet. We pull back in there and we see some buyers jump in, maybe that's the dip. Or maybe it trickles a bit deeper. But, you know, right now you have a president who's openly pumping stocks. And when we do get some reversion, he has a tendency to tilt policy to make it so that market participants have wanted to get on their back foot. Occasionally with these little freakouts like we had earlier in the year around Iran, or like we had last year around tariffs. Remember on this one, it was especially funny because it was just like a month after Trump was inaugurated, and you have a bunch of people saying, oh, you know, he wants to tank the stock market so he can get yields down and refinance debt. Like, you serious? You think Trump wants to tank the stock market? No, he wants to push an economic agenda of tariffs. But, you know, ultimately, when it comes down to it, I don't think he's going to risk the stock market and American businesses on an economic idea or concept, which ultimately he didn't. He backed off of many of those tariffs, and we just flew right back up. So, you know, the opportunity in here, as I see it, is for pullbacks until there's more evidence that this AI concept is going to get demolished. And you know, and I don't think that there's the wherewithal for that to happen right now. What I think ultimately could be the undoing, I got to go over to this one, NASDAQ 100. You know, again, knowing that there's a bubble is not prescription for profiting off of it. And as a case in point, it was like December of 1996 when Alan Greenspan first coined the term that he's widely known for today as predicting the dot-com bubble. December of 96 is when he coined the term irrational exuberance in a speech. Notice what the NASDAQ did thereafter, went up Like let's call it 850 at the time. It went up to 4,800. So more than 5 times, more than 5x. And even when it did bust, even if you would have top ticked Greenspan's comment, you would have barely been in the money if you were short the whole way. You probably would have been stopped out if you had any lever, but even if you didn't, you barely would have had any time in the green. And then it was right back up. Knowing there's a bubble and profiting off it are two very, very different things. Everybody wants to look for the violent move. Those are the harder ones to work off of because there's no statistical overlay for working with that trend. But the more advantageous route is look for these pullbacks and just letting the general trend avail itself. I mean, at this point, you could see we just had one of those pullbacks, right? It was on the back of this Kevin Warsh, more hawkish Fed concept. June 17th was that FOMC rate decision. That is right here, right? We set a lower high and then we unwound a bit. But as inflation is soft, and that's right around the FOMC rate decisions, Warsh did not sound like somebody that wants to suddenly hike and be hawkish. Stocks go right back up. So, the window opportunities I see it is look for pullbacks on the back of stronger than expected CPI data, or even inline CPI data that gives a bit of a pullback, because it doesn't look like this thing is broken yet. All right, I've got a couple comments in here. Pete, good to see you in the room, my friend. Yeah, it's been a crazy couple of months. Yeah, new baby's doing great though, man. We had a couple of frightening weeks there. It came out a little bit early, so some time in the NICU wasn't all that much fun. That's one of the reasons that I got off Twitter and everything. But and then once everything was cool, I just wanted to enjoy the baby. So I had a solid couple of months away from markets, which I haven't done since I've been like 18 years old. Pete says tomorrow dollar yen 155 in a flash. It could happen. Yeah. I mean, I think the scenario outlay that needs to take place for that to occur is I think you need to see a really disappointing USD-CPI print, which I think is possible if we look at the way oil prices have cratered. I mean, oil prices are kind of the underpinning on that whole data point. And, you look at where we've been, remember there's a lag in this data, but oil prices haven't been all that strong. It's been coming back down. So, I think that would be the scenario that'd be necessary for that. But, I think the wherewithal is there because, like I said, when I was listening to Warsh, it didn't sound like somebody that wants to be a Paul Volcker 2.0. Sounds like somebody that just doesn't want people to think he's a patsy, which I get. You just been named to the, most prestigious post of your career. You don't want people to think you're just, some groveling academic looking to implement Trump's economic plan. And so, he wants to sound like his own man. I get it. That's, respect that. But at the end of the day, if he goes out and presides over a rate hike, if he votes for a rate hike himself, can you imagine the social media posts? And this is going into midterms, like it'd be brutal. From Adi, James, after the last intervention from MOF and then BOJ did not hike, this type of uncooperative behavior is unorthodox. So there's another factor that's in there. It's not just MOF versus BOJ. It's also Senate Takechi, right? And if you look at the way that Japanese politics have kind of circled the situation, where Takechi keeps talking about like these taxes and reforms and taxes, and it's almost like she's trying to sidestep the issue altogether. But the reality is, if you're a Japanese politician, there's been so much volatility in a developed nation on the basis of economics and really, which is all determined by that spot rate, that it's kind of like I said around all these Fed members that are sounding hawkish. If you wanted to fix inflation, why didn't you then? It's kind of like, hearing somebody say, "Oh, I want to get in shape," and they're eating a bag of candy. It's like, bro, what you tell me and what you do are two totally different things. So I'm going to believe that either you just don't want to, or you don't want to, and you're just telling me what you think I want to hear. If the BOJ wanted to actually strengthen the yen? They would. The thing is inflation doesn't really demand it, but I don't have Japanese inflation data readily available, but they had a flare where inflation was way above target. They could have hiked there. They didn't. Now inflation's below target, so there's actually no demand for them to hike. But it's a quagmire because, like, you look at Japan, it's an aging population, and I think the last data point I read on this is their population is expected to contract by about a third over the next 30 to 40 years. So how do you keep economic growth when your economy, when your population is declining by a third? You need some like massive innovation, right? Just for GDP per capita to stay flat with a 33% reduction in your citizenship, you need GDP per capita, real GDP per capita, to grow 50%. Then add inflation, you're talking numbers that are just astronomical at that point. Excuse me. And this is like, again, this isn't like a near-term thing in Japan. This is a decades-long saga that they've been dealing with. And really, this whole story roots back to the exchange rate. And it even goes, I mean, I could get real deep in the weeds. I could go all the way back to World War II. But, after World War II, the U.S. goes in and tries to rebuild. And one of the easy ways to do it, I mean, how do you rebuild an economy that is dead? There's no capital in the economy right now. You need to bring capital in. Trade, right? And it's kind of a similar model that China followed. But, you take the famines of the 70s in China, how do you rebuild that? Well, you've got to trade. And, well, your purchasing power parity is incredibly low, so you have an advantage in that you could create widgets for way cheaper in China or Japan and then sell them in the US. You got, a dollar yen spot at 300. It's advantageous for you to make things in Japan, sell them in the US. Here, I got a great example on this, by the way. So 1985, dollar yen is up here at like a 250 spot, right? So you're Toyota or Honda, and you sell a car in the United States for 30,000 US dollars. And your spot rate is 250. So 30,000 times 250, that's 7.5 million. So 7.5 million yen for every $30,000 car that's sold. Now, fast forward a decade, and now you got an 80 spot. Your Honda, your Toyota, same $30,000 selling price. You did not inflate your selling price. You're selling the same car 10 years later for the same price, 30,000 USD at an 80 spot. Now you're bringing back 2.4 million yen. You have just lost 67%-ish of your profit margin for doing nothing wrong. Just an exchange rate. That's it. Your currency strengthened a lot. And so now you at Honda or Toyota are seeing your margins completely evaporate. Now, car margins aren't that high to begin with. So you're probably looking at going from a profit to a loss. So what are you going to do? Well, you got to cut costs. You probably have to raise prices. Now it makes your car less advantageous in the United States because Ford or GM don't have to worry about that. Your competitors don't have the same problem if they're not in Japan. It's a spiraling situation, man, and it's a slow growth, slow death type of backdrop. This is why you have the lost decades of Japan. It was all brought upon by this massive yen strength. Now there was a catalyst for this. It was the Plaza Accord. And we're past the hour, so I'm going on a little bit on the story. It's a fascinating history story. But, the Plaza Accord. Why was the Plaza Accord there? Well, late 70s, U.S. has stagflation, have to hike rates. What didn't happen here, right? And I harped on this a little earlier, in that we never got inflation below 2%. There's actually a cautionary tale from this same story, where we had this stagflation backdrop. And the U.S. jacked rates higher to try to get inflation down. And before it got below target, before it got subdued, they released. And well, inflation just flared again. And so Paul Volcker in the early 80s, he had to jack rates up. He literally knew he was going to engineer a mild recession, but he was going to do it to try to prevent a massive recession or a massive problem down the road or a massive inflationary spiral. And it ended up working. The problem is that it worked a little bit too well. And you look at how strong the USD was, and by the time we get into 1985, just a massive imbalance in trade. And it wasn't just impacting the US. And so that led to the Plaza Accord. The Plaza Accord was an agreement amongst G7 to essentially try to fix currency rates. And this is kind of why I bring up that Bretton Woods scenario around Kevin or around Scott Bessent. But look at how this worked out for Japan, man. We were like 260 before the Plaza Accord, and we were like 80 a decade later. Did not work out well for Japan, unfortunately. You know, kind of like the Treaty of Versailles, but that's another history lesson. But we'll leave that alone. You know, but you think about the way that that exchange rate impacted these Japanese businesses, and it had a sociological impact. Birth rates diminished massively, and that had a hangover effect. And you know, we get into 2011, 2012, it's almost like hopelessness because you got a dwindling population, you got decades of disinflation, deflation, lack of economic growth, and you know, it was essentially the idea, well, hey, we could weaken the yen. We could kind of do the reverse of 1985. And you know, for once, you had a bit of hope that developed in Japan, almost a little bit too much hope too fast. But then, you know, COVID comes around. Oh, hey, we don't necessarily want a strong yen. We don't want it too weak. You know, so we'll back up here at like a 150-ish or a 160-ish. But, you know, we don't want this to go back down to 120 because we know what can happen. You know, and if you look at those demographic trends, you can't just make a bunch of babies in 1 year and just fix it all. It takes time. And so it's a game of political hot potato in Japan, because if you do kill off this economic strength and you got a declining population, there's a legitimate question of, are we ever going to be able to grow again? So, you know, it's kind of like with Kevin Warsh. You hear what they're saying and you see what they're doing, and they don't necessarily reconcile. That's why I think there's been this penchant towards yen weakness, because ultimately the BOJ is not going to prioritize yen strength over economic growth, which is where we are and where we've been. Fascinating story, though. I mean, it's a fascinating study of macroeconomics, and that's why I think what Bessent's doing here is so interesting, because he's talking about a Bretton Woods 2.0. The reason Bretton Woods didn't work is because of the gold standard, and is a concept called a Triffin dilemma. And we don't have the gold standard anymore. You know, everything's free float fiat. So, you know, could it be redone in a more efficient way? I don't know, but it's kind of like cutting edge economic theory. It's just cool to watch. As a trader, it's kind of disconnected from what I do day to day, though. So that's why when I do these webinars, I try to look at setups. I try to keep it back home at what matters. But there is a sideshow that is very, very fascinating right now. So MOF, BOJ, they have totally different jobs, man. MOF, their job is to manage the currency. BOJ, their job is to manage the economy. And they don't always go in the same direction. But the MOF orders the BOJ to intervene because they're the ones that have the actual banking connections. They're the ones that have the actual swap lines to banks to actually do it. From Pete, oh man, such great looks reasoning on these pairs and the greenback. I appreciate that, buddy. Got a couple others in here. From Gerlins to Sir, what's your process for any during a pullback? Do you wait for a specific confirmation signal or a set retracement level, like percentage or moving average, and why? So what is human suffering? I know it's getting grandiose on this, but what's human suffering? Indecision, not knowing what to do, right? There's a Special Forces Q course. They have this thing. It's like one of the final tests, and they tell you to run to a point. You run to the point, and they tell you to run to another point. Run to another point. They tell you to run to another point. You run to another point. You ask, how many more points do I got? Go to that point. They don't tell you. Uncertainty is the mind killer. And that's like that in all of human nature. Not knowing is the worst thing. If you know it's bad, at least you can accept that. You could brace yourself for it. But not knowing is the most painful thing that a human being is ever going to go through. That's the challenge. That's the worst part of short-term scalping. Not knowing. Looking at something and not knowing what you should do. So limit that. Easy if you can remain disciplined on it. I call them decision windows. So if I'm on a 4-hour chart, spot FX is 591 Eastern time where I live. 591 AM and PM, you got a candle that's closing. And so futures is 610 and 2. So the way I look at it is when this 4-hour candle closes, there's a small window with which I can react to that. Yeah, it's the Ranger run. That's right, Pete. They got it in a lot of different operations, like SFQ course has one. I think the SEALs have something similar, although that's more brute force, but there's one for Air Force combat controllers as well. But when this 4-hour candle closes, I give myself about a 10-minute window to react to it. And after that, the candle's done. And after that, we're on to the next candle. And that next candle's pain. And now that's a whole new set of decisions that I don't want to have to deal with for another 4 hours. So for pullbacks, I'm not looking to take first strike. I'm not looking to get it at the bottom wick. I'm looking to get the reaction on the closed candle. And then I have a 10-minute window with which I will allow myself to make a decision on that specific marker. That makes my life really easy. Because at that point, I'm reasonably able to get 4 candles a day, maybe 5, because I got a baby that stays up pretty late and cries a lot, but maybe 5. So at most, I got 50 minutes of decision time in my day. Outside of that, I take that onus off of me. It's not my job to try to predict the way that a candle is going to paint. I look at it for 10 minutes after it closes, and that's my window. So for a pullback, like let's say this euro dollar setup, right? Off this 4-hour right now, and that candle is going to close at 1 p.m. in like 45 minutes. There's nothing really for me to do, but let's say that it had come down, it had penetrated, it had bounced back up, and I got a low underside wick. All right, well, I could work off of the thesis that it had one of those capitulation bottoms in there, and I could react to that within that 10-minute window. I set my stop. I might set, an opposing side limit order. Like I don't want to take off the whole position. I'm usually going to let things run. I'm usually going to look for like scale that exits, but then I could set a partial limit as a function of that stop distance, and then I could let the position roll. And then I'll look at it 4 hours later at 5 p.m. But, the worst thing is not knowing. And I think that's one of the reasons that so many people, ultimately fail at trading, because it's not comfortable. When you're looking at like a 5-minute chart and this candle's going up and down and up and down, and it's completely unpredictable, and your emotions are hanging in the balance the entire way, it's no way to live, man. That's not something that's fun for me. But that's the way I look at it. But that, my friends, is what I have for today. I want to thank everybody very much for your time. I do appreciate it, as always. I will be back next week, same time, same place. Hope you have the time to visit with me again. But thank you for that time, and happy trading, ladies and gentlemen. Thanks, Pete. Good to see you, buddy.